Welcome to Tesla Daily News podcast on April 8th, 2026. Today, we're breaking down the delivery and demand signals moving Tesla, the stock reaction and analyst pushback, a major new chip manufacturing partnership tied to autonomy and robotics, and fresh questions about how driverless Tesla's Robotaxi really is. Let's start with the big headline that set the tone for investors. Story 1. Tesla's first quarter deliveries beat last year, but missed expectations, and the market punished it. Tesla delivered 358,023 vehicles in the first quarter. That's about 6% higher than the same period last year, and it was enough for Tesla to reclaim the #1 spot globally in pure battery electric deliveries versus BYD, which sold roughly 310,000 fully electric vehicles in the quarter. But the hook for traders wasn't the #1 trophy. It was the miss versus the street. Multiple reports pegged analyst expectations around roughly 372,000 deliveries. Tesla came in about 14,000 short. In a stock priced for growth and operating leverage, even a few percentage points matter. Investors also latched onto the production versus delivery gap. One report cited production of about 408,000 vehicles against deliveries of about 358,000, roughly a 50,000 unit spread. That gap can imply either cars in transit, a deliberate inventory build ahead of deliveries, or demand softness that will require incentives to clear. Either way, it creates pressure on automotive gross margins. Takeaway for investors: the quarter wasn't a collapse, but it wasn't the clean re-acceleration narrative bulls wanted. Going into earnings, watch for commentary on pricing, incentives, and whether Tesla frames the delivery shortfall as temporary logistics versus demand-driven. Story 2. Tesla slides, and Wall Street's bear case gets louder. Tesla shares fell about 2% in the latest session highlighted in coverage, with the stock around $352 and change at the close and lower again in pre-market near $348. In broader risk-off trading tied to Middle East headlines and higher oil, Tesla was also down in pre-market alongside other mega-cap tech names. On the analyst side, JPMorgan's Ryan Brinkman reiterated a sell-equivalent stance with a $145 price target, roughly 60% downside from the mid-300s. His framing is important. Tesla's expectations have deteriorated across many operational metrics, yet the stock and some targets have stayed elevated because the market is implicitly valuing a big future pivot: robotaxis, robots, and AI. He also cut earnings expectations, with one report citing a first quarter EPS estimate around 30 cents and a full year estimate around $1.80. Here's why this matters for valuation. Tesla can't justify a very high multiple if the core auto business is growing slowly and margins stay compressed. For the stock to work, investors need confidence that software-like profits from autonomy, fleet services, and potentially robotics can arrive on a believable timeline. Takeaway: the stock is increasingly trading like a proof of execution story. Every data point on autonomy rollout, cost per mile, and real-world service revenue will matter more than incremental Model 3 and Model Y volume. Story 3. Europe demand is showing a pulse. Germany in particular is a bright spot for Tesla right now. Germany's auto market grew in the first quarter, and electric vehicles were the growth engine. In March, EV sales jumped by roughly 2/3 year-over-year, and EVs reached about 24% share of new registrations. Tesla's Germany numbers were eye-catching. It sold more than 9,000 cars in March, roughly 4 times the level of a year earlier. One report put March registrations at about 9,252, up more than 300%, and first quarter total around 12,829, up about 160%. Context matters. Germany's rebound is tied to a combination of a renewed purchase incentive, up to roughly €6,000, and a fuel price shock that's pushing some buyers toward EVs. That said, analysts in the same coverage warned that high energy and fuel costs can also reduce overall consumer purchasing power, potentially delaying big-ticket purchases. Impact for Tesla: strong Germany registrations support the idea that Tesla can still win share when pricing and incentives align and when consumers are reminded of total cost of ownership. For investors, the key question is whether this is sustainable demand or a pull-forward effect driven by incentives. Takeaway: watch European mix and pricing. Volume is helpful, but margins will decide whether this translates into earnings leverage. Story 4. Intel joins Musk's Terafab, a big strategic signal for Tesla's autonomy and Optimus roadmap. Intel announced it's joining Elon Musk's Terafab AI chip complex project alongside Tesla, SpaceX, and xAI. The stated goal is massive, producing the equivalent of 1 terawatt per year of compute for AI and robotics. Tesla's angle here is straightforward. Custom chips are becoming central to its strategy for full self-driving compute, the Cybercab robotaxi platform, and Optimus humanoid robots. Tesla has said Terafab involves major spending, with one report citing an estimated investment of about $25 billion and broader 2026 capex expected to exceed $20 billion. Details to focus on. The plan includes advanced manufacturing and packaging under one roof, with reports mentioning 2-nanometer class technology and internalized supply chain control. The promise is more control over cost, supply, and performance, and less vulnerability to future chip shortages. But investors should hold two ideas at once. First, upside. Vertical integration in compute could protect Tesla's autonomy and robotics pipeline and potentially lower long-run unit costs. Second, risk. This is huge capital intensity, and the payoff depends on Tesla converting compute into revenue, meaning robotaxi network economics, software take rates, and real utilization in factories for Optimus. Takeaway. Terafab is bullish for the long-term moat if Tesla executes, but it increases near-term execution and spending risk. On earnings calls, listen for concrete timelines, production milestones, and how Tesla plans to monetize the compute beyond internal use. Story 5. Tesla admits remote human intervention in robotaxi operations, a credibility and regulatory issue. A report citing a letter Tesla sent to a U.S. senator says the company acknowledges that, in certain edge cases, its robotaxis may require human operators to take control remotely, not just provide guidance. Tesla says this happens only in highly specific situations, and the vehicles reportedly stay below about 16 kilometers per hour while under remote control. Context. This isn't unique in the industry. Waymo and others use remote assistance. But the distinction investors care about is marketing versus reality. If full autonomy still needs occasional teleoperation, regulators may classify the system differently, timelines to scale could slow, and the cost structure changes. Remote ops teams are real operating expense. And competition is moving. Waymo is expanding driverless service to new markets, including a fresh rollout of fully driverless rides in Nashville. That keeps pressure on Tesla to show measurable safety performance and scalable operations. Takeaway. For Tesla valuation, robotaxi is a potential step function in revenue. Remote intervention doesn't kill the thesis, but it raises questions about readiness, unit economics, and how quickly Tesla can expand a truly driverless service. Story 6. The macro backdrop, oil shock, and risk-off tape still matters for Tesla. Markets are volatile around escalating Middle East tensions and the risk to shipping lanes. Oil has jumped, and equities have moved lower in response. This has two competing effects on Tesla. 1. High gasoline prices can boost EV interest, as seen in Germany and in UK EV sales hitting records. 2. Inflation pressure from energy can keep interest rates higher, which makes car payments less affordable and can weigh on auto demand broadly. Takeaway. The macro picture may help EV adoption but hurt affordability. For Tesla, that usually means more price competition, more incentives, and tighter margins unless software and energy profits offset. Before we wrap, here are the key themes to remember today. Tesla is back on top in global EV deliveries, but the quarter still missed expectations, and the stock is trading like an execution referendum. Intel joining Terafab is a major strategic win for the compute roadmap behind autonomy and Optimus, but it also raises capex and execution risk. Robotaxi credibility is in focus as Tesla acknowledges remote human intervention, while competitors like Waymo keep expanding driverless service. For tomorrow, watch for more delivery and registration data from Europe, any new details on Terafab timelines and partners, and shifting market risk sentiment tied to oil and the broader tape. If you found this useful, subscribe to Tesla Daily News podcast for your daily, investor-focused Tesla roundup, and follow us for updates every market day.